Okay, so you're supposed to have your information. So let's just look at what they're giving us. Okay, that's exactly how we should not manage our fixed assets. We should always try and keep it in pristine condition and also use it responsibly. Okay, keep it in good condition, it will last forever. You ensure it's of a good quality. Eventually, you might get a higher price when you want to sell it again. Okay, so let's look at the information they're giving us. In this case, they're giving us information regarding 3 vehicles or 3 fixed assets that we have. Okay, we've got a caddy. Here we go. That's the caddy that we bought on the 1st of January, and we're going to replace it in 2018. So we bought it in 2008, and we're going to replace it in 2018. The cost price, 200,000. Then we also have a Toyota. We bought it in July, the 1st of July 2018, and the depreciation method is going to be 10% per annum on the cost price. And then we're going to replace that in the year 2028. In the third item that we bought, it's a Honda motorcycle, but it forms part of vehicles. We bought it this year, which is the 30th of April 2019, and the depreciation method is 20% per annum on the carrying value, and it will be replaced in the year 2029. Okay? But now they're talking about 3 different depreciation methods. So we're going to look at the different depreciation methods first, and then we'll tackle the different items. So if we're looking at 2.1, for example, they're asking us, explain what the straight line method is. Okay, so that's for the caddy. We bought it in the year 2008. We're going to replace it in 2018. That means, and we're going to depreciate it according to the straight line method. Okay, so the straight line method means that the depreciation will be written off over the useful life or the life expectancy of the asset. Okay, so the depreciation will be written off over the useful life or the life expectancy of the asset. And in this case, it is expected to last 10 years. Okay, so from 2008, that's when we bought it, and we're going to replace it in 2018, so it's supposed to last for 10 years. So for the caddy, that's the vehicle that we're talking about now. The useful life is 10 years. So the cost price is 200,000. The useful life is 10 years. That means every year you're going to write off 20,000 rand worth of depreciation. So every year, if you have it for the full year, you're going to write off 20,000 rands worth of depreciation. So how did you get the 20,000? We took the cost price, 200,000, divided by the 10 years it's supposed to last, or the life expectancy, and that will give us the 200,000. We will do that for every year, except in the 10th year or the last year. Then we'll only write off the depreciation of 19,999. Why do we do that? Because we want to keep a residual value of 1 rand. If you're going to write off the full 20,000 in the final year, then the cost price and the accumulated will be equal to 200,000. And then the carrying value will be 0. So we cannot have that. Therefore, we have a residual value of at least 1 rand. That is why we take away the 1 rand over there, so that we have to write off the depreciation of 19,999. Okay? But for a normal financial year, it will be 20,000 every year. And because we bought it in January, the depreciation for the year December will be 20,000. except in its last year, then it will only write off 19,999. So that is what the straight line method, it's all about the life expectancy of the asset, and in this case it's 10 years. So it's the cost price divided by the 10 years to give you 20,000 per year. Okay, so let's have a look at the second vehicle that we have. It's a Toyota Avanza. The cost price is 300,000. And in this case, the depreciation method is 10% per annum on the cost. Okay? So what does the cost price mean? The cost price method means that a certain percentage of the cost price will be written off every year. Okay? It says a percentage of the cost price is written off annually. And in this case, it's 10%, which means 10% every year. So it's a fixed amount. It's also called the fixed installment method. So it's 10% every year. So for the Avanza, it's 10%. So it will also last for 10 years. Right, but the depreciation for a financial year is 10% of the 300,000 times 12 over 12, which gives you 30,000 each and every year. But in our first year, we bought it in July, and the financial year ends on the 31st of December. So in our first year, we'll only have it for 6 months. And therefore, we'll only have to write off depreciation for 15,000 in the first year. But all the other years after that will be 30,000, except again in the last year, where we need to keep that residual value of 1 rand. But that explains the cost price method. Okay. Then for the motorcycle, we bought it in April of this year. Again, we're going to replace it in 10 years' time, but this time the method is 20% per annum on the carrying value. So the carrying value is a percentage on the carrying value, which is also known as the book value. Okay? It's also called the diminishing balance method. So to calculate the depreciation, we have to say, take the cost price minus the accumulated depreciation times the percentage, and in this case, the percent is 20%. But in your first year, grade 11s and 12s, there is no accumulated of the previous year. So in your first year, you will be using the cost price method. But in the subsequent years, then it will be the diminishing balance. So what we're saying for the diminishing balance, or for the reducing balance, or for the carrying value, the amount of depreciation is bigger in the earlier years, but smaller in the later years. That's why the word diminishing balance. As the years goes on, the amount of depreciation that you'll be writing off becomes smaller and smaller and smaller. Okay, so that is just to explain the 3 different methods that the question is talking about. So let's see what's the next question, right? They want us to calculate the depreciation on the caddy every year. Okay, so they want for the caddy, the useful life is 10 years. We saw that earlier. That was the first part. Okay, so every year we will have to write off 20,000. Again, it's the cost price divided by the life expectancy, which is 10 years. That's where we get the 20,000 from. Right. Then for question 2.3, they want us to calculate the total accumulated depreciation on the Toyota Avanza on the 31st of December 2019. Okay. Now remember, we bought it on the 1st of July. And we want to know the accumulated depreciation on the 31st of December 2019. Okay, that means that we have the vehicle 1.5 years. So if we want to make the calculation for the depreciation, then it's going to be 300,000, which is the cost, times 10% times 1.5 years. So the accumulated depreciation will be 300,000 times 10% times 1.5, that will be the years. It will give me 45,000. Okay, that was for the 1.5 years that we have it. In other words, from the day, the 1st of July, until the 31st of December. Okay, let's just see if there's anything. While we're looking for that. Okay, what's happening with the Honda motorcycle? They've got 20% on the carrying value. And it says, calculate the total accumulated depreciation on vehicles on the 31st of December. So we know that the Avanza is 45,000 because we just did that in the earlier calculation. And also we know that the Caddy, it's past its life expectancy. So we can only have 199,999. Why? Remember, it's past the life expectancy. So we can only have R1 residual value. Therefore, the total accumulated is 199,999. Right, so what's happening with the motorcycle? It says that we bought it on the 30th of April. And we want the accumulated on the 31st of December. Now remember, we're in the same financial year, but we cannot count April. Why? Because it was bought at the end of April. So we need to count from May until December. Okay, so that gives me 8 months. But now, grade 11, why am I using the cost price method over here, even though they're telling us it's 20% on the carrying value? Remember, we're in the first year. So in our first year, there's no accumulated of the previous year. So now all we have to do, we have to take the cost price, which is 120,000, times 20%, times the number of months that we own the Honda. In other words, from the 30th of April until the 31st of December. So we're owning it for 8 months. Therefore, the value will depreciate only for 8 months. It will give me 16,000. Now just have to add those three together because the question is on all the vehicles. They want to know what's the accumulated depreciation on all the vehicles. Okay, so it's 45,000 for the Avanza, 199,999 for the Caddy, and 16,000 for the motorcycle. Gives me a total of 260,999. Okay, let's look at the next question. They're asking, what is the carrying value of the Caddy on the 1st of July 2020. Remember, the caddy has a life expectancy of 10 years. That means that we are past the life expectancy. That date, the 1st of July 2020, is past the life expectancy of the caddy, which means by that time, the caddy is fully depreciated, but there will be a residual value of R1. Okay? So the carrying value will be R1, which we get from the cost price minus the total accumulated that was for the number of years. Remember, we said that's going to last for 10 years. But now, because the vehicle has reached the end of its useful life, but we are still using it, we will have to record it in our books, and the value will be R1. The carrying value or the residual value will be R1. And we won't be writing off any depreciation on the caddy anymore after it has reached its useful life. So now the caddy, because it has reached the end of its useful life, is maybe one of those vehicles that you should consider to sell or to trade in. Okay, and that will probably lead us to the next question, where it says that a car dealer has offered her 50,000, but a friend has offered her 80,000. Now, obviously, she will accept the 80,000. Now the question is, explain why this was a wise choice. And there we have the answer. Remember, the carrying value is only R1, and we're selling it for 80,000. So we're selling it for 79,999 Rand more than the carrying value, which means we'll be making a profit of 79,999. If she had to take the offer from the car dealer, then she was only going to make a profit of 49,999. So obviously, she's making more profit. So therefore, it was a better decision to sell it for the 80,000 than giving it to the car dealer. Okay? And the 79,999 will be shown as an income in the statement of comprehensive income. Okay? And obviously, because she's getting rid of it, she obviously has to buy a new vehicle. Now, instead of having 50,000, she now has 80,000. She has a bigger deposit on the new vehicle. Instead of having 50,000, she will now have 80,000, and that will obviously then reduce her debt with the car dealer if she goes and buy a new car. So she's not taking the 50,000, she's taking the 80,000. So she'll have a bigger deposit on the new vehicle with the car dealer. Okay. Then, because she has 80,000 instead of 50,000, she can now negotiate a better purchase price on the new vehicle. Because instead of giving 50,000, she's now got a bargaining of 80,000. So obviously she can try and reduce the cost price of the new vehicle that she's going to buy. Okay? So those are just one of the reasons why she's going to accept the 80,000 instead of the 50,000. Okay? So making a bigger profit of 79,999 instead of 49,999, which is a difference of 30,000 Rand. So she's only making 49,000 if she took it from the car dealer, but she's making 79,999 if she's selling it to a friend, and that will be a cash offer. She's got a bigger deposit, which is obviously the 80,000 instead of the 50,000. And because she's got a bigger deposit, she can negotiate a better purchase price for the new vehicle. Okay? So those are just a few of the reasons why she will accept the 80,000 instead of the 50,000. Okay? Right. Then grade 11 and 12, that is more or less the end of activity number 2. Okay? So those few questions was just for you, reinforced your knowledge that you already know about fixed assets. So what we're doing now, we're looking at going a little bit further. What do we do when we have the asset disposal? Okay? So we're taking some of that information, especially for the caddy, because that will be the one that will be a deal candidate to sell. It has reached the end of its useful life, although we can still get 80,000 for it instead of 50,000. Okay? So what we're doing now, we're incorporating, taking the information from number 2 and going over to activity number 3 and just showing us what the asset disposal account should look like when you do it in the general ledger. So let's just look at the next slide. There we go. So that's the information regarding the caddy. Remember, we bought it in 2008. We're replacing it in 2019. Sorry, in 2018. So the useful life is 10 years, but we're selling it on the 1st of July. But by the end of 2017, that's the end of the 10th year, then the vehicle has already fully depreciated. So we cannot write off any more depreciation. So on that day, the accumulated will be R1 less than the 200,000. Okay, so if we're looking at that, the asset disposal is just an intermediary account. The only thing that you need asset disposal for is to determine whether you're making a profit or a loss on the sale of the vehicle or equipment, if it's equipment. Okay, so the asset disposal account, it's an intermediary account. It's only used when we have asset disposal. It will never have an opening balance and it will never close off. It is just used to determine the profit or the loss when we're having a sale of an asset. It could also be that we have no profit or no loss if we're selling it for what it's worth or the carrying value. Okay, so what we're looking at here is we're selling it on the 1st of July. So the dates will have to be the 1st of July. The cost price is 200,000. That's your cost price. Because vehicles will be recorded at the historical cost or the original cost price, the cost price will remain 200,000. Okay, so that will be taken away from the vehicles account, and that 200,000 will appear on the debit side of the asset disposal account. Okay, so now we have the cost price, but remember that we are on the 1st of July 2020. We are past the date of the life expectancy of the caddy. The caddy is only supposed to last 10 years, but we are already past the life expectancy. So the caddy has fully depreciated, which means the accumulated depreciation on the caddy is R1 less than the cost price, which means the accumulated depreciation is 199,999. Okay, so again, the cost price is 200,000. The accumulated is 199,999. Why? It is fully depreciated. It is past the life expectancy, but it was still in use, and we cannot write off depreciation anything more than 199,999. So if I have my cost price and I have my accumulated depreciation, I can determine what's my carrying value. And that we also got from the earlier activity where we found out that the carrying value of the vehicle is 1 rand. So that will just be the difference between the cost price, which is 200,000, and the accumulated depreciation, which is 199,999. Okay, so in our books, the carrying value is 1 rand. But remember, just because it's worth 1 rand in the books and it's fully depreciated, it doesn't actually mean that the physical vehicle is worth 1 rand. It's just in our books, we have written it off completely. It's fully depreciated. It's only worth 1 rand. That is only in our books. But obviously, we're going to sell it. And in this case, they're giving us, we're selling it for 80,000 and we're selling it cash. That means we'll be receiving 80,000 and we're selling it for cash. So therefore, it will be bank and 80,000 on the credit side of the asset disposal account. Okay, let's just see if there's any questions. Right, so we're selling it for 80. So why bank? Because we're selling it for cash. Okay, so it will be bank. If we sold it on credit, then that details would have changed to debtors control. Okay, but for now, it's bank because we sold it cash. Okay, so the total will be 279,000. So remember, this vehicle in our books is worth 1 rand. We're selling it for 80,000. We're selling it for 79,999 rand, what it's worth in our books. So in this case, we'll be making a profit on the sale of asset of 79,999. Remember, we sold it for 80,000. So 80,000 minus what the car is worth, or the carrying value, gives me 79,999. That figure would obviously have changed if we had to take it to 50,000, then that would be 49,999. I showed you that on the earlier slide if they had to take up the option. But if they had to take up the option, then it wouldn't have been bank the details over there. Then the details would have been creditors control because it would have been a trade-in. It's only bank because it's cash over there. Remember, that is how we got rid of the asset. It's bank if we sold it for cash, which it is in this case. It could also be debtors control if we sold it on credit, or if we trade it in, it can be creditors control. Okay, so that is what your asset disposal account will look like. Let's just have a look at that. Right, we can see the cost price, 200,000. Accumulated depreciation, 199,999. It's fully depreciated. Life expectancy is 10 years. We are past the life expectancy date, so it's fully depreciated. So we cannot have the cost and the accumulated the same amount. That is why we have the residual value of 1 rand. We're selling it for 80,000. So we're making a profit of 79,999. Okay, that's a very important account. Just to make sure that you know how to do the asset disposal account. They might not ask the account, but they will ask you maybe just to calculate the profit or the loss on sale of asset. Okay, but in this case, we're making a profit. Okay, so let's just look at the second part of that question for activity number 3. It says, indicate the effect of the cash sale of the caddy on the financial statements on the 31st of December 2020. So if we're looking at financial statements, we know the one is the statement of comprehensive income, formerly the income statement, and the statement of financial position, formerly the balance sheet. Okay, so what we're looking at is what is the effect of the sale on the statement of comprehensive income. So we can just go one back quickly. Remember here, we made a profit of 79,999. So that profit will affect, ultimately, it will affect our income in our statement of comprehensive income. So, under the line item operating income in the statement of comprehensive income, we will have an item called profit on sale of asset, and that will increase my income, and ultimately it will increase my net profit. So the effect will be an increase on the operating income in the statement of comprehensive income. Okay. Then, if we're looking at the statement of financial position, right, here we'll be losing a vehicle, which means our fixed assets, that will be in note number 3, our fixed asset note. We will be losing a fixed asset, and the carrying value of that fixed asset is 1 rand. But my bank will increase by 80,000 because we sold it for 80,000 rand cash. So I need to make sure that everything is in balance. So if I take the 80,000 and I take away the 1 rand, I'm left with 79,999. A bank will increase with 80,000 because I sold it for cash. I'm receiving the money, but my fixed assets will decrease with the carrying value of 1 rand, and the 1 rand was 200,000 minus the 199,999, which was just on the previous slide. There we go. That was the carrying value. So that part, that will go here. Here we go. That is the, okay. That is over there. So it's plus 80 minus the 1, and then it gives me 79,999. Just remember, there is a third financial statement, but all they want in this case, they just want us to record the effect on the statement of comprehensive income and the statement of financial position, formerly called the income statement and the balance sheet. Okay. In essence, grade 11 and 12, that is the end of activity number 2 and activity number 3. So that is to make sure that you more or less understand how to deal with asset disposal, what will the effect be on the financial statements. Like I said, just remember, there will be a statement of comprehensive income, there is a statement of financial position, and then obviously the third one, where we have to show it, what will the effect be of the sale in the cash flow statement. But for this question purposes, it was only for us to show the statement of comprehensive income and the effect on the statement of the financial position, which is called the income statement and the balance sheet. Okay. So what we're looking at, because we have enough time, we can actually go over to activity number 4, just to make sure that we got everything regarding the fixed assets. Just remember, so it was just to explain the depreciation methods. So we were looking at the straight line method, then we were looking at the asset disposal, then we showed you how to write off the depreciation on the item that is fully depreciated. So it was just so that we have a residual value of 1 rand. So now we're going to look at what happens when we buying an asset, and what do we do? How do we record it on, let's say, the accounting equation, or maybe just for account debit and account credit. So for that, we just need to go to activity number 4 in your workbook, that is on page 7. Okay, so what they have on page 7 is where the owner is actually buying a Nissan bakkie, and the cost price of the bakkie is 350,000. Okay, so there is already a transaction, by the way. There is a transaction where it says that she purchased a new Nissan bakkie for 350 on the 1st of July, and she bought it on credit. Okay, so that is a transaction. So that means that she actually bought a vehicle, and my vehicles will increase. Therefore, I'll have to debit the account vehicles. So my vehicles will increase with the cost price. But now, the account credit is, how did I buy the vehicle? Did I buy it cash? Then I will have to write bank, because then I'll have to record it in my cash payments journal. Or did I buy it on credit? Right? Did I buy it on credit? That means I owe somebody money. And that person that I owe money is called a creditor. Therefore, the account credit will be creditors control. So if I'm looking at what's happening is my assets is increasing. Therefore, it's debit vehicles. And my liabilities is increasing, which is creditors control. And the amount is now 350,000 because the bakkie was 50,000. 350,000, excuse me. And then it says that she paid with an EFT, so that abbreviation is electronic fund transfer. She paid with an EFT 20% of the deposit. Okay, so 20%. So now she's not buying a vehicle. Right? She's now paying. Now she's not buying the vehicle, she's paying. So now she's paying the creditor. So now the creditors will decrease. Okay, so creditors control will decrease, and my bank will also decrease. But with 20% of the cost price, which is 20% of 350,000, which is 70,000. Then, so if we're looking at now first, my assets is increasing with the vehicles, my liabilities is increasing with the creditors control for 350,000. So now I have a vehicle of 350,000, but I owe the creditor 350,000. So now I'm paying the creditor. So I'm paying the creditor. So first of all, I'm paying him 20% of the cost, which is 20% of 350,000. That gives you 70,000. Then we're also paying for the installation of a tracking system and a gear lock, which is 8,000. So that is more or less a permanent feature on the vehicle. So that 8,000 is actually going to increase the cost price of the vehicle. It's like the carriage that you have to pay for to getting the trading stock to your premises, and that carriage that you have to pay will increase the cost price. So what we're doing here, we're paying for the installation of a tracking system and a gear lock, and that will increase the cost price of the item. So instead of having it for 350, the cost price will now increase by an extra 8,000, which means the total cost price will now become 358,000. Okay, So now, because we have to pay for it, it will be as if we're buying a vehicle. So again, on account debit, it will be vehicles. So there you can see there's vehicles with 350,000, and there we have a vehicle of 8,000, but we're not buying a vehicle. Okay? It's very important, grade 11 and 12, that the 8,000 will only increase the cost price of the vehicle that we're buying, but we're not buying a vehicle for 8,000. It's for the installation of a tracking system or a sound system or an alarm that you have to put into the car, and that will increase the cost price of the item. Okay? So otherwise it's going to look that you're buying a vehicle for 8,000 Rand. Okay? But the cost price of this vehicle was 350, and the upgrades, the installation of the alarm or the tracking system, that's an extra 8,000, and that will increase the cost price with the extra 8,000 Rand. Okay? In the last transaction there, it says that the licensing, and we're paying for the number plates, that's more or less for the registration, that's an extra 2,000 Rand. Now that will have to be done every year. Every year you have to renew your license. So we cannot say that the 2,000 Rand will actually increase the cost price of the vehicle. That is a recurring expense you'll have to do each and every year. So the licensing, you'll have to do it each and every year. So that will just be a normal vehicle expense that will not increase the cost price of the vehicle. So for looking at that, it will just be that we're paying, so that we're going to group under vehicle expenses. Okay. Then again, it's going to be bank, and we're paying 2,000 Rand. So the 2,000 Rand will not increase the cost price of the vehicle. Only the 8,000 Rand will increase the cost price of the vehicle. So again, if we just look at that, the first transaction was that we bought a Nissan Bakkie for 350,000 on credit. And for that, the entry was vehicles and creditors control. Then we're paying 20%, so bank will be credited. That means creditors control is debited with the 20%. Then we're paying for the installation of a tracking system and a gear lock, and that will increase the cost price. So the 8,000 will increase the cost price. So the total cost price will be 380,000. And when we have to write off the depreciation on that particular vehicle, it will be seen as 358,000 and not 350,000, because the 8,000 will increase the cost price. In the same way, it's as if you're buying a laptop with no operating system and no Microsoft Office. And because they're installing that, that will increase the cost price of the laptop that you're buying. So the installation of a gear lock or a alarm system, that will increase the cost price of the item that you buy. Okay, so then we get to the last question. Now they're asking, what is the cost price of the Nissan Bakkie reflected in the fixed asset register? So remember, if we go back quickly, we said the cost price was 350,000, but the installation cost for the alarm system, that will increase the cost price of the vehicle. So ultimately, when you answer that question, it should be 350,000 plus the installation cost of the gear lock or an alarm or a tracking system. So ultimately, in your fixed asset register, that Nissan Bakkie will be shown as a cost price, historical cost of 350,000. And once it starts depreciating, you'll have to write off the depreciation on the cost price, which is now 358,000. Okay. At grade 11 and 12, I think that comes to that's the end of the presentation that we have today. But what's very important, first of all, when we're looking at fixed assets, you must remember that this year your accounting paper will be split between paper 1 and paper 2. And fixed assets is one of those topics that will appear in both. One, because we're dealing with the calculation on the one side, so you will now have to do the asset disposal account, and also we're dealing with the management of fixed assets, which will appear in paper 1 and in paper 2. So when you are revising and you are studying for an exam, which will have 2 papers, you must ensure that fixed assets is covered in paper 1 and in paper 2. Just remember, there's different ways of writing off depreciation. You'll have it on the sold, that will be the asset disposal, on the old, and on the new. But when you're dealing with the fixed assets, you must ensure that if you're studying fixed assets, please study the internal controls regarding fixed assets as well. So every time when it's a topic that you're studying, please ensure that you do the internal controls as well. And like I said, asset disposal is a very important subject, so you need to know it not only for paper 1, but also for paper 2. I'd like to thank you very much for listening and following. I hope that you stay safe, stay inside, work, work, work. Also, just remember that the more work you do at home, the better for you when we return to school. So ultimately, the more work you do at home, it's going to become easier in the time when we go back. So please ensure that you use this time productively. You work at each and every subject. And then once again, please stay safe, stay inside, and God bless. Goodbye.